Good. Traders, welcome to the first ever Tradecraft. I'm so excited to be launching this with you guys and to be here with you. And yeah, this is going to be a lot of fun. I'm going to open up the chat box to everyone so you guys can all chat together and we'll have a nice little community. But this is going to be a lot of fun. So thanks for tuning in and checking this out. And, be sure to tell your friends, right? I think the idea behind this is as long as it's growing and thriving, we'll keep doing it. So this is going to be a weekly thing. So welcome and let's get to it. All things trading. So good spot to be. So first of all, welcome. This is Jim Simmons and welcome to the first ever Tradecraft. So what we're looking at in these events ultimately is foundations of trading, strategy, risk management, psychology, community, and execution. Ultimately, that's what we are after. The purpose of this is not to just give you information for information's sake, right? We're not here to just give you a bunch of stuff and then just let you decide, how on earth you're supposed to put that into practice, right? The idea behind this class and this free event is to help you have better decisions, better execution, and ultimately, you know, of course, you're going to learn more. That's part of it, right? But it's about how do you take that information and put it into practice, right? The weekly session is going to be built into segments. So ultimately, we'll do a market breakdown each week where we'll kind of go through what happened in the past week, what we're looking forward to for the next week. Then we'll go into some risk management. We'll do, one risk management little segment each week. We'll do one psychology segment each week. And then we'll go into a lesson. The lesson is going to be on, the foundations of trading, and all sorts of different things like volume and structure and order flow and anyway, all that type of thing. Then at that point, we go through actionable frameworks. How do you take what you're learning and put it into practice, either in the form of strategy or filters or something that can enhance your trading strategy? So that'll be your actionable framework, if you will. And then at the end, we'll spend some time looking at the charts, and time permitting, we may even look to enter a couple trades, and then we'll send you off with some homework, which you can do or not. I'm not going to check your homework, so it's mainly for your own benefit. Okay. So that is the story of Tradecraft. So let's get into it. As for the agenda, again, as far as this week, what we're going to cover is what causes the market to actually move. A lot of traders think they understand this, but maybe there's some missing gaps in that knowledge. So we're going to look to fill in some of those gaps. We'll do a review of the markets, a review of this past week in the markets. Again, risk management lesson. Our lesson for the week is planning the trade the right way. Yeah, these are all recorded. Absolutely. So planning the trade. The trader psychology is going to be based on the need to be right, which I know none of us struggle with. So you can just, go grab your cup of coffee during that segment. But no, that'll be a really great lesson. And then we're going to look at balance and breakouts. So balance versus imbalance in the markets, understanding what a breakout actually is. I would say most traders trade breakouts wrong. We're going to look at how to be smarter with our breakouts. It all comes down to improve your win rate, improve your expectancy, improve your bottom line. That's what this is all about, right? Actionable trading framework. We'll look at chart examples. We'll look at reactive trading versus restraint. And I can tell you from personal experience, and you've probably seen this, when you wait for the right conditions, the market pays you better. It just does. So we're going to look at that in a practical sense as well. And then we'll look at weekly assignments. What can you do to further enhance your understanding and ability to break this all down? Now, of course, before we get too far, we do need to post our disclaimer. Again, we are not here to provide signals. We're not here to tell you what to trade, where to trade, when to trade, how much. That is up to you. There is risk in the markets. You are responsible for your own risk. We are not your trading advisors. Past performance does not guarantee future success. If we are all good, give me a yes in the chat box. We will keep going. Cool. All right, let's get into it. So let's look at this week in the markets. We'll do a review from the news side, and then we'll do a review from the, from the charts. Okay, so we'll review key moves, levels, lessons from the trading week, major market themes, important events, significant directional moves, balance expansion, key levels, and something that you can ultimately take with you. So if we start with looking at, let's go to the news first. Let me do that. Where are we at? Here we go. So here's our market briefing for the week. Ultimately, quick summary, risk reduction and rotation week. Let me share this with you guys too. You're welcome to hang on to this and read this more thoroughly on your own time as well. So there's the link if you want to follow along, and you can read this on your own as well. But this is we'll do this each week where we have a weekly market briefing. So cooling CPI and PPI initially supported equity and bonds, but we know that that was kind of short-lived. The relief overwhelmed by larger forces, sharp unwind in semiconductors and AI leadership. Escalating Iran tensions, push crude, resilient economic data, hawkish Feds, the rate hike is still possible. Inflation gave some release. If we look at CPI, 0.4 month over month, so a little bit of an increase, not too bad. Producer inflation PPI declined 0.3, and this fell 0.4. So a little bit of a fall there. Consumers remain stable, and they were. Labor market doing pretty well. We saw jobless claims dip and new claims dipped as well. Feds kind of staying put for now, but possibility for potential rate hike. Next meeting is end of the month. Iran energy, no news there. Obviously pushed crude higher. We'll look at the chart though, and you'll see that, yeah, it looks like there's a huge, jump in crude, but we're still below the annual highs, and we're still kind of going sideways, which is good for us when it comes time to put gas in the car. Equities, NASDAQ, huge dips, right? Huge fall on NASDAQs over the week. This is led by primarily the semiconductor AI related stuff. Those segments fell pretty heavily, which is what affected NASDAQ the most, because obviously very tech heavy. And so that certainly matters. There's some key levels in here that you could take a look through. We'll go in and look at the charts, but if you want to keep these levels on hand, you're welcome to. S&P, a little bit more resilient than the NQ, but still falling there as well. Russell is kind of somewhat unaffected. Not as much of a heavy reliance on AI and semiconductors and that sort of thing. So it's, kind of a little bit even more resilient than the ES. So still kind of hanging in there. Dow, defensive relative strength. I don't really watch the Dow too much. I don't know if you guys trade it, but there's some info there. Price action on crude, could it go up? Yeah, it's, saying 85 is the major psychological target. Hey, Marcelo, what's up? And so, it's got some levels there for you. Gold, a little bit weak. Very interesting. On track to lose more than 3% this week. So 39.87, certainly down off of the highs there as well. Bonds, yields, dollar, you can look more into that. Obviously, bonds and all this is very affected by what the Feds are doing. Housing, hanging in there, doing okay. Single family starts fell, single family permits dropped. A lot of the real estate is kind of pushed by multi-unit. So that's the story there. The big story is concentration risk. Obviously, if you were, holding on semiconductors and AI, you got hit a little bit this week. Could they return and bounce back? Sure. Who knows? I don't know. I'm not that smart. I just look at what's happening and trade it, right? Um, Saying when do we start looking bullish? The levels there that would suggest that maybe we're on a turn. That's in there for you. Ultimately, CPI, PPI kind of a little bit down. For risk, don't assume that it's going to continue. First of all, it could. There's actually no major news coming next week, so there's a possibility, and at least going into Monday, that it'll be more of the same. But of course, we never really know what's going to happen next in the market. It's not our job to predict the market, which we're actually going to look at here in a little bit. Not our job to predict the market. Our job is to trade the market. So, um, a lot of those major releases are behind us. Next week is pretty open, not a lot of news. Watch crude. Obviously we'll be looking at, is there any major political news or geopolitical news that, so keep a close eye on crude. Don't take your eye off the ball on that one for sure. Quiet macro calendar, though, does not mean quiet markets. There could be, a lot happening with the earnings coming this week. We've got some pretty notable earnings coming in this week from, it was Google, Intel, Tesla, American Express. So there's some big ones coming this week. So that could sort of get the defibrillators out, and depending on what those look like. So pay attention to those. Make sure you understand when those releases are coming so you can be aware. I think most of us aren't really trading late in the afternoon, but keep an eye on those for sure. Psychology, don't buy every dip. Buy the dips, buy the dips. It's a good way to lose. Sometimes it'll work, sometimes it won't. And again, our job is not to just assume it's going to continue or assume that it's going to change or assume anything. Our job is to trade what the market is telling us and recognize the opportunity that's there. So inflation, it's a little bit cooled off, which is good, but oil prices are still high. And so there is your weekly briefing. If we look at next week, really we have crude oil, and then we have unemployment, and that's really about it. So there's not a whole lot from a macro perspective that's going to sort of make the markets jump in any major way aside from the earnings. But just keep a close watch. But it should be a relatively, these low news weeks, they tend to be a little bit easier to trade. So we'll see some good opportunities there. So that's good. If we look at the charts, let's take a look at, from a macro view, what do we have going on over the past week? So if we go to, Monday, and we just kind of draw a line in the sand here and say, okay, what happened this week? Well, we always kind of zoom out and get a feel for the market was, kind of chopping. We had a nice little down move here, and then we stayed inside this little down move, ultimately topped out a couple of times, and then ultimately broke the low, and it was, off to the races. If we look and zoom in a little bit more, we can look at our trend break here, came down, nice little trend opportunity here. And certainly you could look at anchoring. There's my anchored VWAPs. There we go. That is not, let's fix this. I don't know why this is different. I had to redo this chart. So let me see if this one is correct. Hang on. I had to put a new chart in here and it changed my defaults. Yes, it did. All right, well, let's fix it. I'll make this easier to see because most of you know I use VWAP for just about everything. So VWAP is your friend. Let's do that. That looks better. All right, we'll make this save as default. Okay, cool deal. Good to go. So there's our, anchored VWAP on the way down. You had some nice consolidation there and a huge push down. At this point, we would look to anchor here. As long as we are below this, we're looking at shorts. Ultimately, is what we're after here, and we broke right on through this low right there. I'm going to change this to white as well. Okay, we'll do that. So there we go. So there's quick analysis of NQ. Obviously, very, very bearish. I don't know what's going on with the gap. I'll talk to the team on that, but good to go there. If we look at ES, we kind of take a look here. ES has not hit the lows, right? The lows were back here from Friday, back in June, actually a couple weeks ago. Pushed the highs, topped out, broke the low here, and ultimately falling pretty heavy there as well. So there we go. So nice little break there. And then anchored VWAP would be here. So still below, obviously, the VWAP there as well, and actually pulling in a little bit into that VWAP now. GC, let's go take a look. It hasn't hit the lows entirely. Huge bounce off that low from last night. That's a pretty significant bounce off that low on the hourly chart. So just here recently, let me move this over. There, we can see a little better. Looking at, from this point of view, we would have a break here, break back up. For those of you that know your SMC structure, we'd be down here, and that would be ultimately the break. Broke through that and then got hung up on this low right down here. And that's annoying. Literally everything has changed. All my defaults are gone. That's all right. We'll just do that for now. So there's our low, coming into that low, definitely bounced out of there. We're still bearish, big picture. We had some consolidation in here, and then if we move that there, nice reaction there, and then it's holding below the anchored VWAP here quite a bit. So could it go bearish from here? Yeah, it could, but it's been very sideways in here. So to me, if you look at big picture context on gold, there's really no direction. We've hit the anchored VWAP numerous times at this point. There's a chance that they might have to come and sweep up to the order block up here. Interesting. Where's my... All right. My drawing toolbar is missing too, but that's okay. We'll just we'll go with it. I'm looking for a rectangle. Here we go. So there's a chance that they come back up into here and go back and test this. There we go. No, not that one. This one. Keep drawing. No, magnet. Yes, that's the one we want. Sweet. Okay, so there's a chance that they come back up to test this level next. I would expect some resistance off of this. Market kind of went sideways. We have, speaking of balance versus imbalance, that is imbalance. That move right there on that huge push down, that's an imbalance in the market. It was balance, 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 break. Never came back to test it yet. So there could be a strong opportunity for the market to come up and grab some additional liquidity up here. Okay, so that's kind of my read on this. Support at the lows, resistance here, very weak resistance here. I think that's kind of what I'm looking at. Yeah, market resets, exactly. That's exactly it. That's a good way to look at it. Let's go to crude. So crude, we look at it, and I only have so much data on the Tickblaze web. They don't do a ton of historical data on these, but if we're looking at, yes, we had a huge move on Monday, Tuesday, kind of pushed up, but really it's been sideways, all week. It's just been kind of lingering sideways here. Let's make this favorites. There we go. Um, we've been kind of going sideways for the remainder of the week. We just pushed through. This is the thing that you're going to see. A lot of traders are just going to jump right in and trade that. You have no idea what the stopping point is. We could say there's a psychological level at 85, and that would be a good risk play. If you look at long positions, let's do this. There we go. Here's my favorites. They disappeared on me. Now we're back. Good. You could look at, okay, well, there's a chance to go long in here, and oh my gosh, this is a great opportunity, and I'm going to trade this. And for a one-to-one trade, with not a lot of conviction, there's not a lot of confirmation that that's going to necessarily hold. So we're going to look at that today. How do you determine whether the market has enough follow through and enough backing behind that move that says, okay, now I can trade it? So reaction versus restraint, that's kind of what we're going to look at. But ultimately, crude, breaking through the highs. Technically, we would have a break of structure here. If we go to, where's my trend line? There we go. Let's make that a favorite. That can be a favorite. Perfect. Yeah, so if we look at, there's our break of structure. Order block off the low is going to be, let's make this a favorite. There we go. Oops. That one. So, there's our order block, big picture, and so there's your support potentially. Now, here's the trouble. Anytime you have order blocks that are inside of a major consolidation, what you have is you have balance inside of balance. And it doesn't necessarily do a whole lot for you like it would if the market was, say, right here, where it's a clear move down and then up and out. These tend to be more stronger than balance inside of balance. There is a time that you can look at trading these. We're going to look at that today, but ultimately, I wouldn't just set your watch and say, okay, I'm going to take a trade right here, because you would want to wait for confirmation on something like that first. Okay. RTY, we can see that, with NQ and ES plummeting, RTY has held on. Really this week we had a nice push up. Not sure what happened there Tuesday, but big move maybe off the market open or so. That might have been CPI, PPI. Yeah, that might have been CPI actually. Anyway, huge move, swept the highs, came right back inside. So from a perspective on RTY, who knows? It's really just kind of still stuck inside of this big range. It's a big range. There's definitely enough to take trending day trades on this market, but pay attention to the highs and lows. Don't trade long into the highs. Don't trade short into the lows. Always know where you're at on the big picture. So that's kind of an analysis of where we're at in the markets and things like that. Crude, you could take trades on crude. If we look at, let's go to a smaller time frame and see where we're at, right? I mean, there could be, coming off of the crude open, that was a huge move. Let's go here. Let's change this on a 5-minute. Yeah, I mean, all day cruising back up again. So this is a pretty strong move to the upside. And we broke through the highs. If we, put the line in the sand here and say it really didn't stop at that level. So it pushed right on through, came back, tested it, pushed through again, came back, tested it, pushed through again. And now the market it's tempting to want to go, okay, I can trade the pullback in here, and this is going to be great. And it can be tempting to do that, but there's a time when you recognize that the market is just overextended, and these pullbacks in here may not be as friendly as what it may seem, versus compared to this one where there was key strength also at a significant level, which then got tested again. So we're not in a trending environment yet in crude. it might be tempting to think, well, we've had a big push up, so yeah, we're trending. Not on a 5 minute, we're not. At this point, it's overextended. So, how do you know that? Well, just look at the big picture. It pushed through the highs outside of a major balance area. This would be like probably more like a daily balance area. Let's go to the daily and see. Too big. We do have 4 hours. Let's try that. There we go. um, it didn't fill that in. Anyway, that's fine. But you could see here, this is a 4 hour balance area. And so there's your high, there's your low. It stayed inside the entire time. It is just now broken outside of that. So we don't have any confirmation that it's going to stay outside of that. And that's actually what we're going to be looking at primarily today. So crude for me would be a no trade. I wouldn't do much on it unless it's a really small time frame, personally, to answer your question. So good deal. All good so far. Any questions so far? Everybody, what do you guys think? You good? Give me a thumbs up. Still doing well. You guys don't need another cup of coffee yet? All right. So let's go to risk management. Let's go to our risk management segment. So what we're going to look at today is defining the risk before the entry. Now there's an idea. There's an idea. The position should follow the trade structure. It shouldn't be static. It shouldn't be emotion based, You know what your chart looks like, right? If you're on a range chart, you know that your bar size is fixed. So your range is fixed. Therefore, most of the time, your trades are also going to be fixed size. So if you have a 10, I don't know, you have a 10 tick range bar, you might trade 15 or 20 ticks. And in that case, you're going to have the same contract sizing each time. If you're on a variable range bar, most of the time, your stop size is going to vary. So based on that, your contract size should vary. Now, here, depending on how fast you are looking to trade, right? If you're on a really fast bar size, you could get away with just using the same size contract on your trades. And this is actually what I do. Okay, I look at MNQ and I say, oh, okay, 160 ticks is really going to be the largest trade that I take on NQ. I like to trade pretty fast. And so 160 ticks is kind of what I'm looking at as a max. The drawdown to this is now my 160 tick trades, I might have to size down one contract. Now I'm trading micros and that's fine. I might size it down one contract on the bigger trades. And then I might keep a static, 2 to 3 contracts on the micro based on my sizing for these accounts. We might do 2 to 3 contracts. If it's a standard size position, I'll go 3. If it's a larger position, I'll just go 2. And that's it. I don't want to spend a ton of time trying to figure out what my sizing would be. So what I do is I look at, if the max risk per trade is 160 ticks on a micro crude, that's $80, or micro and NASDAQ, that's $80 in risk per contract. If I want my trades to stay under 150-ish, then that puts me at 2 contracts. I'm at 160. I can live with that, knowing that it has to be a really, really strong trade on that larger position, right? It's got to really be worth it for me to take that trade. And so I'll measure the trade in advance, just get a feel for how big the market is, and that'll tell me if I need to trade, 2 or 3 contracts, whatever the case might be. So that's a way to look at it. Most traders, though, especially if you're on MNQ, you might have one trade that's 40 ticks and you might have the next one will be 200. You're not in a position versus someone who is 80 to 160 on average. Yes, there's a 2x opportunity here, and that's why you size down one contract, right? Versus if your range is 40 to 200, well, you're going to need to size those differently. and you're going to need to look at measuring that trade out to figure out how many contracts is going to get you to the risk that you're looking to take. So the time to define your risk is not when you're trading. The time to define your risk is before you start trading. And it should all be based on your max available drawdown. Max available drawdown, not max drawdown, max available drawdown. So this works in two ways. One, let's say you have a max drawdown of 2,000. And when you are first getting started on the account, let's say you want to have, I'm just going to use a 20 multiple because that is smart risk. Could you do 10? Yeah, if you're only taking like 1 or 2 trades a day. If you're taking 3, 4, 5 trades a day, you might want to consider a higher multiple to size your risk. Hint, hint, wink, wink. I can't tell you what to risk, but that would be my strong suggestion. Let's go to orange so that we match. There we go. So, so if you have a $2,000 max drawdown and divided by 20, you're at $100 per trade. Now, if you're trading MNQ, that's going to be hard to do. I get it. Maybe you go to 150 or something. That's, maybe that works for you. But if you're at 2,000 and the first day you take a loss and you're down 250 for the day, your max drawdown is not 2,000 anymore. Your max drawdown is 1,750. So you size your trade based on max available drawdown. So now, of course, this is the downside, and this is how you trade out of a drawdown. Your equity curve looks like this. Smiley, happy face. If you don't, your equity curve usually looks like that. It's a free fall. You're like that guy who's trying to, maybe that's a little too morbid, but you guys ever see that guy that had like free climbed Yosemite? Okay. Thankfully, he's still around to live and tell the story, but yeah, that's what it would look like. That guy is nuts. He is completely verifiably insane. His amygdala is off. So there's the risk. Now, what if your account has plenty of extra profit? That same account, because most of these prop accounts that you're trading, the minimum balance is going to get fixed. If you're on a 50K account, it's going to be 50,100. If your balance is 56,000, your drawdown is not 2,000 anymore. Your max drawdown is 5,900. Assuming you don't have any additional limitations on max positional risk, you could use this to size your position. So now you take 5,900 divided by 20, and we'll just call it $300 per trade. So you've essentially, tripled your max risk that you're comfortable in this case, doubled it, and you have more room to breathe. And 300 risk is still well within the limitations that you might have on a prop account. And some of you are looking at this going, oh, 150, 200, man, I've been risking like 1,000 per trade. And you wonder why you're failing your accounts. Right? So identify what your risk is going to be before the trade, before you start trading for the day, and then size your position according to your stop distance. It's all done through risk reward tools. I mean, I'm not going to really bring up the desktop, trader, but we can look at, even on the web trader, you have position sizing that you can do. So if you're saying, okay, I'm going to get long here, and you go to the little long position thing, which disappeared again somehow because it's on this chart, but not this one. That's fine. We'll just grab it real quick. Where are we at? There we go. So you're saying I'm going to get long here on support because it's clearly this is support because it hit twice. First off, good luck. Support is, there's only so many times support is going to continue to be support. If you keep hitting something over and over and over and over, eventually it weakens. It's just physics. So could this hold? Yes. Is it going to? Who knows? No idea. But if you're looking at trading this back into the highs at 1-to-1, that puts your stop right below that level. And you might look at this and say, this is a great trade. Okay, well, how many ticks is it? What's your position sizing? What do you need to be sizing these at? You have the opportunity to set that in here. So you could say, count size, whatever. You can just call it 50,000. This is just doing a one contract. Risk percent, yeah. Let's see if we can do this by dollars. We can. So if you want to risk 125 per trade, there you go. Let's see if that is right. I don't use this too much. So amount 49,875. You would think that it would do the actual risk. Anyway, you guys can dig into that. I don't really use this too much. I'm trading on the desktop mostly, but there you go. So now this is telling you quantity is 181. Yeah, not so sure about that. But anyway, size your positions in advance. So at this point, we can see that this is coming into support and it's holding. We're getting some confirmation here. You can go to a smaller chart, on crude, you've probably, okay, maybe it's not holding. All bets are off. Anyway, let's go back to 5-minute. And now it's back up. Weird. This thing's doing some weird things. I'm going to send this to our team so they can fix this because I don't know what the story is there. Anywho. Yeah, you get the idea. Bear with me 1 second. I just need to do something real quick. All right. Getting a little toasty in here. I kick down the AC. How you guys doing out there? Are you guys breathing okay? Man, it is nuts out here. Can't even see anything. It's just clouded with smoke. Smoke everywhere. Good deal. I can't see straight. Yeah, same in Cleveland. Yeah, same all throughout the Midwest, I'm sure. So yeah, I do see your questions. I promise I will answer you guys. What's the best or ideal time frame on MNQ, MES, MCL, MGC? It depends. It really depends on what you're trying to trade. Here's my philosophy. It's not a tried and true. It's not you don't have to do this, but this is my take on it. 5-minute charts or better for minute charts. If you're going to trade on the minute charts, stick to a 5-minute or better. 3 minutes, maybe 3 minutes, but 5 minutes and up is where you want to be. Anything less than 5 minutes, then you want to switch to a volume or a tick chart because they're going to be smoother. If you notice on a 1 minute, you might have this huge bar, tiny bar, tiny bar, tiny bar, huge bar, tiny bar. It's very noisy, very, very noisy. So if you're going to trade on a 5-minute, do that. If you're going to be less, go to a volume or a tick chart. If you're trading order flow, then you want to go to a range chart. If you're trading structure-based signals, then you might want to go to Renko. So this is my take on it. This is how I approach it. I don't really do much with seconds charts unless I'm on really, really small time frames on a level 2 chart, but that would be my take on it. And then from there, it comes down to how many signals are you going to get each day? And then how good are those signals? Because more signals doesn't always mean more money. Sometimes more signals equals, I just degraded the value of my signal by getting too many. And so by sizing up, you'll usually get stronger signals. By sizing down, you usually get weaker signals. So hopefully that helps give you some answers there. You could always put those charts into AI and plot out your signal and just evaluate it that way too. Sometimes a second set of quote unquote eyes, even though they're robot eyes, can be really helpful. Brian's asking, how do you find the bar close on Heiken Ashi bars? You don't. It's really technically not possible as far as my understanding of Heiken Ashi. Do we have Heikinashi in here? Yeah. So Heikinashi, the open is going to be the average of the previous bar, is my understanding, and then the close is the average price of the current bar. So you really don't know what the close is unless you go to a time-based bar or something. So yeah, yeah, you're on fire in Colorado. I heard that. Yeah, I've got some family out there that are having some trouble with it. Yeah. Yeah, so there you go. Let's go back to candles. Good to go. All right. So on risk, again, define what your dollar risk is going to be in advance, measure your stop, use the tools that are available to you. Tickblaze has a really great risk reward tool that you can measure everything out. Or you could just put into the entry what your risk is going to be and let it size the position for you. And I believe you can do that in here as well. So if we say we want to put a limit order copy price 81.29, we could just enter that because it's simple enough. And you go 81.29. Okay, so that's our buy limit. Um, what we can do is we can say risk. Now, obviously, we have to put a stop in here. And so, you would measure out your stop. Let's say it's 81.30, and we want to have our stop down here at 80. We'll just call it 80.60 for the sake of math. That would be 70. Um, that'd be 70 ticks. Yeah. And then then you would put your risk in as on CL. You'd probably have to be at least 500. Um, it is a whole number. Oh, this might have taken us below one contract. So let's do 1,000. Okay. It's my number. No. Try that again. There we go. Okay. We're good. And then your take profit, you would just put, if you want to do ticks or reward or price or whatever. In this case, we could just say it's 70 ticks and we'll do 100%, 1-to-1, 100%. Yeah. Okay. Whatever. We'll just keep it there. Um, so there it's saying your risk is 700 or 1,000, your reward is 700 for whatever reason. Trade value on the futures, it doesn't matter. On stocks, it would. But on futures, it's all based on margins and leveraged positions and all that. So anyway, so that's another way that you can size your positions using the tools available to you. How do you decide when to take profit during a scalp or intraday? It depends. For me, I look at our multiples. And depending on the trade that I'm trading, I usually like to be around a 1-to-1 for my trades. That way I know if I hit 2 out of 3 of my trades, I've got a 2-point profit factor. I'm happy. Life is good. It's fine. I can tolerate that. So I do 1-to-1. Scalps, you might skew that the other way and say I might take a 0.5 target and leave a runner or something like that. So depends on the strategy that you're trading and how quick you're looking to get in and out. The other thing you look at though too is, let's say my 1-to-1 is above the highs, then I might just bring it inside the highs to make sure I have a better chance of getting something out of the trade versus it going almost to target, turning around, and then kicking me out at break even, for example. So um, never force your stop to preserve your position size. So this goes back to measure the stop first. If we go back to the chart for a second here, if your stop is going to be right here, that's going to be a dangerous stop because you're inside of support. So there's a higher likelihood that it's going to get hit. Most traders are putting their stops beyond the swing low. And so measure that out first. Don't force your stop to have to do something because you have to trade for 50 ticks. Let the market tell you how many ticks to trade for. You size your contracts based on that, right? So, yeah. Yeah, goes hand in hand with planning your trade entries. Yeah, exactly. Exactly right. So let's talk about psychology. Let's move into psychology now. Risk, we've covered the risk management, psychology. It's not your job to be right. If you learn nothing else today, learn this. It's not your job to be right. But I love being right. Uh-huh. Me too. But it's not your job to be right. You are right when you manage risk, and you are right when you execute your trade plan. That's it. That's how you are right. When you're not trading, we talk about this a lot around here. This is my best way to put this. There's an engineer and there's a technician. The engineer's job is to create the plan. The technician's job is to execute the plan, right? So when you are trading, you are a technician. You're not an engineer. It's not your job to question the plan. It's not your job to size the positions differently. It's not your job to move your stops and targets to placements that you don't have in your trade plan. It's not your job to filter out additional trades based on highs and lows. If it's not in your trade plan, you don't trade it. End of story. If it is in your trade plan, you do trade it. You don't skip it. It's that simple. Your job is to be a technician when you're trading. When you're not trading, that's the time to be an engineer. Most traders are terrible engineers. It's not because they're not capable. It's because they may not have enough knowledge to be able to put that plan together. In all other aspects of life where you go to make lots of money, doctors, physicians, surgeons, attorneys, so on and so on and so on. To do those jobs, you go to school for a very long time. You learn what you need to know to be successful in that role. So, why do traders think that they're just going to trade the market for 30 days and all of a sudden they're going to be an expert on trading? It's nonsense. Now, unfortunately for us, there's not really a degree course where you can go and learn this stuff. A lot of the times it's outside of the realm of traditional education, right? So, but you're not going to just learn something, after 30 days. So technician and engineer, you get some help on the engineer side, engineering your trade plan, your risk plan, all of that type of thing. Get some help with it, whether that be you're implementing a plan that somebody else is already trading successfully and it just happens to work within your strengths, your weaknesses, who you are as a trader, and what you can reasonably do. If you need help with that, Tickblaze does have programs for that. ATS, AQS, that's where you want to be if you need some help with it. So, what a lot of traders, what we see is they have their trade plan looks like this on the map. I've got this little kind of blip on the map of what they're trading, and the map looks like this. And so they have this little tiny little thing that they've kind of planned out, and it's like, okay, yeah, I can trade on that. Well, it's like trying to find your way to where you're going, only seeing this much of the map. It's sometimes we need a little help as traders. I have yet to meet a trader who has made it entirely on their own without some help from somebody else, myself included, right? So, so get some help if you need it. But your need to be right does not exist in the market. Again, what makes you right is you execute the plan and you execute your risk plan. And when you hit your max winners or your max losers, you freaking stop trading. You're done for the day. Don't keep going. If it's in your trade plan to stop at 3 trades, stop at 3. If it's in your trade plan to stop at 5, stop at 5. Don't keep going. Well, I'm having a really great day. Yeah, until you give all the profit back. Well, I'm having a really crappy day and I can find my way back. Said no one. Famous last words. Okay. So stop when you're supposed to stop. Certainty will never exist in the markets. Um, Unfortunately, there is possibility, there is probability, and we trade based on probability. We do not trade based on certainty because it does not exist. Possibility, probability, certainty. All you get is probability. That's it. Yeah. Make your plan or you will be the plan. Absolutely. Love it. Define the confirmations, define your invalidations. This needs to be in your trade plan. I don't have a trade plan. Well, it looks like you got something to do for the rest of the weekend. Build one. And if you need help, reach out to our team and get involved with some of the programs that we have available. Uh, you know, get it into your trade plan. If it's not in your trade plan, you can't trade it. If you don't have a trade plan, you can't trade. Them's the rules. You can trade, but you're trading somebody else's trade plan, and it's not going to work out for you, right? Respond to new information. If the market is telling you we were bullish, we are no longer bullish, why are you still trying to trade bullish? Time to stop, right? Judge your decisions by process, not outcome. This one is huge. Judge your decisions by the process, not the outcome, by the execution, not the result. I literally have, so in our programs, I've built out a coaching portal for the ATS and AQS. There's a coaching portal. It's really cool. So it's coming soon. So we'll keep you guys posted, those of you that are in the program. So in this coaching portal, you are going to grade yourself on did you follow your trade plan? Yes or no? What was the result of the trade? Win, loss, break even. This, when you're first starting, means little to nothing. This is everything. Did you execute your trade plan? Yes or no? If you execute your trade plan, congrats, you get a win. If you did not execute your trade plan, you get a loss. If you had a trade that you didn't take, you get a loss. That's simple. Did you follow your plan? When you're getting a new trade plan in place, it starts with the trader and it goes to the trade plan. You cannot fix the trade plan unless you know the trader is doing what they're supposed to. Because how can you know if the trade plan works or not if you're not even following it? Like, that's insane. Insane. So there you go. Psychology. Good stuff. Can you please show 3-bar and compass? I don't have it. I'm just on the web trader for this event, so I don't have it, unfortunately. But I'm sure there's some videos out there that you could check out for sure. So let's look at our lesson. Let's go into the lesson for the week. We've covered some good info. We're going to spend some time on the charts, and now we're going to learn some actionable insights into market movement. How does the market move? Apparently, I misspelled something. I'm going to fix it because it will bother me. There we go. That looks better. Okay. So supply, demand, liquidity, price moves based on aggression. Everybody thinks, well, it's the difference between buyers and sellers. If there's more buyers, price goes up. Yeah, but, right? Look at it this way. If you are buying a car, the dealer has an asking price. You are the buyer. You do not want to pay asking price. Why? Because you want a deal. You want to save some money. You don't want to give your money to them. You want to keep your money. So as a buyer, you're going to make an offer. The offer is called the bid. Somewhere between the asking price and the bid is where the deal will take place. Let's get rid of these. And we'll do that. There we go. So somewhere in between these is where the deal is going to take place. If the seller is low on inventory, that means low inventory means increased demand, right? Because there are more buyers trying to buy that item. We'll just call it a car in this case. What's going to happen is the highest bid is going to win. That is what we call An auction, right? When you go to an auction, you got, you know, you can't even understand them, and they're throwing prices and 25, 25, hey, 25. Okay. So they're doing this whole thing to try and get the highest bid because that's what it's going to sell for. It's the same thing in the markets. If the buyers, if there's more buyers trying to buy at that price, what happens is the price goes up. You're no longer paying the bid, you're paying the ask because there's not as much inventory. On the flip side, if there's tons of inventory, these are all wheels of cheese. Who knows? And there's only two buyers. Price is going to have to come down to meet the buyers. So that's how price moves. It moves based on buyers going to the asking price and above in some cases, or the sellers going to the bids because it's all really a ratio of supply and demand. So what moves price, you have a bid and you have an ask on every chart. Now, obviously, this moves pretty quickly. We can't see it in, just looking at it. You just see the price move and you go, okay, it's moving up. Well, why is it moving up? It's because the buyers went to the asking price. That's what caused the price to go higher because they were outbidding other buyers. Make sense? You guys tracking with me okay so far? Good, good. So that's what moves price up or down ultimately. Now, when you think about mechanically in the markets, what would be buying at the ask? Who can tell me? If you buy at the ask, what type of order is that? If you buy at the ask. Yeah, would be demand, would be aggressive. It's a market order. That's right. All of them technically right. That's a market order. So if you hit buy market, what you're actually doing is you're buying at the next available asking price. You're just saying, I just want in. I know it's going to go up. I perceive that there are more buyers trying to buy at this price than there are sellers. So therefore, I'm going to buy now because I know price is going to go up. That's why you buy. And when you hear buy low, sell high, yeah, but buy low when it's going up or that you perceive it's going to continue to go up. So, or you could say buy high, sell higher. you know, it's not that simple. Trading's usually not. But that's what causes the market to move. Market orders are consuming liquidity. When you have resting orders in the market, let's say you have 50 contracts resting. Sorry, I'm drawing with my mouse. You have 50 contracts resting at, I don't know, we'll just call it 85 bucks on crude. Okay. And there's probably more resting at that price. But anyway, that's okay. You got all these resting at 85 bucks. You have sellers saying, if you come up to 85 bucks, I will sell and you can have the contract. So if you go to 85 bucks to buy, and the price is at 84.90, price just went up, right? This is an extreme example. But the 50 contracts that are available, that is liquidity. You might have heard it called level 2. Level 2 just means you can see the liquidity or not. Level 1 does not see the liquidity. Level 2 sees that liquidity. You can see how many contracts are resting at this price. Now, what happens here when you have, let's say this is the highs, and it's above price. Price is here, and then it comes down. Somewhere in here, there's going to be a bunch of resting orders, a bunch of limit orders. This is going to be liquidity. These are going to be sell limit orders. What you don't see in level 2 is stop orders. What kind of orders are stops? If you have a buy stop above price, what kind of order is that? Right. That is a market order. Yeah, because you are buying at the best available price because you're saying, holy smokes, I got to get out of this market because it's going to keep going up. So above price, you have three different things going on. You have sell limit orders that are resting. You have buy stop orders, and you have FOMO / breakout traders. But I trade breakouts. Yep. You might be a FOMO trader and didn't even know it. So this is BS. You have a bunch of orders that are going to take place up here. What happens is if you're buying on this stop orders and you're buying on the FOMO orders exceed that of the resting sell limit orders, price is going to surge coming out of that. So whenever you see price surge out of a high market right here, this was a surge because there were sell limit orders here. The buy stops from those sellers, because you had sellers here, you had buy stops from those sellers that were going, oh, we're going down, we're going down, we're going down. I'm selling, I'm selling, I'm selling. All throughout here, you have tons of selling. What happens is when you got down here, you had buy limit orders. Those buy limit orders exceeded stops and market orders. Now, why do you suppose the buyers were buying in here? Why do you guys think they would buy there? Because they know the sellers are aggressively trying to short that level because it's a major level. They know that the sellers are going to try to short there. So they're buying here, buying here. They're defending price. The sellers don't have enough momentum to carry the price down further. The buy limits exceed, there's no stops getting run. Long story short, that's why it didn't go down, because it didn't hit the stops. It couldn't. There was too many buyers. The buy limits exceeded the short market orders, either through stops or through FOMO traders. So you had some selling up in here and up in here. Those sellers, where do they put their stops? Above price. So when you have buyers here getting in, then you have stop orders getting run, then you have the price starts to surge, the FOMO traders get in, and they drive price all the way up. Yeah, you're welcome, John. We'll get the recording over to you. All the buyers are starting to surge because you've got the stops getting hit, and then all the FOMO traders kick in and they start running price. The smart buyers are waiting for confirmation. Remember, we talked about this level as support. And most traders are going to look at that and go, ooh, support. I can totally trade this. What just happened? You're getting run. You're getting run over. I told you. It's not a good support level anymore. It's already gotten hit twice. There's no likelihood that it's going to hold up. It's a flip of a coin. Remember, possibility versus probability. So there you go. So there's your level got run. Now we are back to bearish. Where are we going to? Probably to test these areas because that's where new buyer liquidity is at, buy limit orders. So when you see these kind of things, interpret what's happening in real time. You could say, oh, the sellers tried to sell, tried to sell, tried to sell. They got met with buying multiple times. You'll hear me in some of the more advanced classes. We teach who's in control of the market. And we can tell that by break, little bit of stop orders are going to get run. Anytime there's a break, a little bit of stop orders, these are going to be sell limits, and we've got buyers, buyers, buyers. At this point, the buyers are still in control. Now, why are the buyers in control? Because they keep running the highs, defending the lows. Until it breaks through this trend line would be the first sign that the sellers have taken back over. They didn't. The buyers came out of this wedge or the flag or whatever you want to call it, I don't care what it's called. It's called the market's going to go up. So the market goes up, run the highs, sellers try defending their position. What is happening here? Who can tell me what's happening at that price at that time? Anybody have any idea what happens here that caused that market to go back down? What do you guys think? I'm going to trick you. What do you guys think? Profit taking? Yeah. Yeah, that's a good one. It's a good way to look at it. Profit taking for sure. What else? Overbought? Yeah. What else? What else is taking place there? Stops on the shorts. A little bit. Yeah, a little bit. Sweeps. Yep. What caused the market to go down here was market orders. Remember, anytime the market is moving, it's moving with market orders, not just limit orders. Limit orders are the first sign. If the limit orders exceed the buy stops, price will go down. But usually market orders are what's moving price up or down. Remember, you have to go to the bid or you have to go to the ask, one or the other. So market orders came in here. Why would there be market orders to go short here? Anybody have any ideas? Why would there be market orders there? Who is selling on market right there? I'm going to tell you, the sellers who got in here. You're probably thinking, what? Why would they have selling there if their stop was up here? Because what happened is they had a stop loss on a market order. They canceled the stop because they know they're going to be right. Remember, the need to be right. Think psychology of traders. They got in here. Oh, crap. There goes my level. Uh-oh. They just took out the highs. I'm going to sell here so that I can save face and I can be right. What did they just do? DCA, dollar cost average. They thought, oh boy, I got to get, okay. Crap, now it's going up even more. Eventually it's going to stop and turn around, right? The dear life, they're hanging on. They're just adding fuel to the fire. The buyers that were getting in here and here, where did their stops go? Right there. Because they were so aggressive, they knew that that position was going to work. Now, look, if you got in here and put your stop here, you are in very good shape because the market happened to continue to go up. They got lucky. I mean, they got lucky. Yeah, they got lucky because they said, okay, this level broke. This is a decent trade right here. You put your stop below that level and you got plenty of room to take some profits in there on a pullback. It's a great trade. No problem with that. Where it gets to be heavier risk is right here because they could easily sweep this level, fill in the fair value gap, run all the way through into the order block before going back up. Yeah, exactly. So this is aggressive. This is insane. This is insanity right here. So this is good, not good. You're in big trouble. Most traders can look at this and go, oh yeah, it's a clean breakout. It's good support. Blah, blah. No, it's not. It's not. Yeah. So you have sellers, more sellers fueled by stops. That's where you see the run. So when we talk about imbalance in the market, that's imbalance. That's imbalance. That's imbalance. This is sort of imbalance, but really from here to here. Why is this called imbalance? Look at the gap between the previous wick high and the next wick low. It's what we call a fair value gap. That is imbalance. Imbalance means one-sided market, lots of buyers going to the asking price. That is what's happening in the market. So when you're evaluating what to trade, if you're newer, start with higher bar sizes. Start with a 5-minute chart if you're newer to trading. If you're more advanced, you can go down to very fast charts. If you're insane like me, you might trade a 377 tick chart. because I'm crazy. Okay, very fast on NQ, MNQ. So that's balance versus imbalance. Yeah, these would be usually about 90 minutes, Ed. Yeah, exactly. So let's take a look. Let's see if we can find some balance and some imbalance. How do you find balance? If we know what imbalance looks like, what do you think balance looks like? Who can tell me what balance looks like? It's going to be the opposite as a hint. Oscillations, range. Yeah, overlapping bars, right? This is balance. Let's do this. Bear with me while I set my favorites on this chart too. The good thing is you do it once and you don't have to do it again. So that is a good thing. So let's set our favorites and do that. Nothing in there. Let's do longs, shorts, anchored VWAP without a doubt. How many of you trade with anchored VWAP? Anybody here trading with anchored VWAP? Give me a yes in the chat box if you trade with anchored VWAP. Good. If you don't trade with anchored VWAP, it's not that you don't trade with it. It's that you don't trade with it yet. Trust me. It is the greatest tool known to traders. Hear me on that. Let's turn our little magnet on. There we go. We are going to be in good shape. Maybe. There we go. This looks like balance. A lot of overlapping candles, tight ranges. The balance is actually technically going to stop. I don't want to stay in draw mode. Wrong one. Okay, that's better. Nope. Go away. Thank you. Okay, the balance is actually right here. That's your balance. Market came out. Just kidding. I got to come back to balance. Ooh, think of it like you're a hibernating bear and you don't want to leave your cave. That's your balance. The bear comes out. Nah, I'm not interested. I'm going to stay here a little while longer. They finally come out and they're going to stay out. The time you want to trade in balance is, what do you guys think? When do you want to trade in balance? It's a trick question. When do you want to trade in balance? Yeah, exactly. Nobody said it, so I'm going to say it for you. Can we say never? The time to trade inside a balance is trading 4-hour balance on a smaller chart. That's the only time you want to trade on balance. If you're on an entry chart, the time to trade inside a balance is never. Why? Because these are landmines. You are going to get blown up. I promise you. You do not trade in balance. You trade when balance is out. How do you know when you are outside of balance? Well, it closed out, so I'm going to trade my breakout here, right? Strike one. Okay. I'm going to wait for it to come out. Then I'm going to trade the retest. So if you got a F here, that's your grade. Here, you got a C minus. It might work, might not. What? That's how I've been told to trade breakouts. You wait for the breakout, you trade the retest. It's smart money. Not really. If you want a 50-50 shot of making money, cool. There's your trade plan. Remember what we talked about. Most traders do not know how to engineer a plan. It's not that they're not capable. It's just they haven't learned yet. Restraint versus reaction. This is immediate reaction. This is secondary reaction. This is restraint. That's what you want to trade. So when you're looking at a balance zone, especially, you wait for the market to leave entirely. One open, high, low close above the zone. So if you have a zone like this, your open, high, low close, meaning a full bar outside of the zone, not touching. That is your first sign that the market could be leaving balance. Remember this, balance is a magnet. You're welcome, Edward. Glad to help. Balance is a magnet. What happens when price leaves balance? It always wants to come back to balance. Always. Market always wants to seek where liquidity is very strong. It's always going to come back to balance. Always reverts back to the mean. That's right. Well, there's no such thing as always in the market, but you get the idea. Very, very often, market is going to return to balance. We don't know if it's going to stay in the balance. You could come out like this and then it stays in the balance. Meanwhile, you're holding the trade up here. Your stop is here and you're saying every prayer known to man, hoping that the market is going to come up. Instead of looking at hopium, we can trade here, look at this break and say, okay, now I have two opportunities to trade this. I can trade the pullbacks into, a decent pullback into the trend, corrective wave, whatever. You could trade that a couple times there, or you could trade the order blocks coming out of that low, which would look like this. And that becomes a tradable zone. Now, if we fast forward, I don't know if it ever came back to this one. Oh, look at that. Did it work? I don't know. Let's zoom in a little bit more. Did it work? Yeah, it did. Why? Because this is the liquidity that fueled the move that stayed out of balance. If the market wants to come back to balance, we know that that is the tendency. If the market stays out of balance, that means the market is very strong. Because to overpower the desire for this market to come back here and stay, you have to have very strong buying that says, I want this market to move up. This is what you want to trade, not this and not this. Does that make sense? What we're doing is we're taking the 1, 2, 3. You watch the YouTubes, you watch the gurus, you watch this and that, and you say, this trading is as easy as 1, 2, 3. And then you go and you blow out another account and you go, what the heck is wrong with me? This guy made it look so easy. Well, because he forgot about steps 4, 5, and 6. If you're going to make a lot of money, do you think it's going to be easy or it's going to be a little bit more complicated? It doesn't have to be complicated, but it's going to be more complex than a simple 1, 2, 3. Balance, come out of balance, stay out of balance, come back, tag it, whatever the case might be, and then leave and stay out. I will trade that. Not 1, not 2, the third. Yeah, I'm playing market manipulation. The boss after the retest is the confirmation of the uptrend. Yes. After the retest. Retest doesn't look like this. That never left. That's not a retest. It never left. The bars are still touching the balance. It's still inside a balance. There's the leave. There's the retest. There's the break of structure. There's your move. So do you want to trade this and then get chopped up? The other possibility is that it does this, 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 slam. How many times have you seen that? Oh, I don't know, 10 million times. Let's find an example of that because I guarantee it's on this chart somewhere. There's a little bit of balance here. This is probably a better balance zone, a lot of chop there. So we can look at this whole zone here is really chop. What happens? Psych. Traders that put their orders down here on a breakout, they're thinking, ooh, we load up, got stopped out. Dang it. The market left the balance, and it did. You have an open high-low close above that balance zone. What happens next? Blast through the other side. So if you're trading the retest, what just happened? You lost. So sad. If you waited, you never took the trade. because you were smarter than the average trader. You had restraint versus reaction. This is how you trade, not, oh, here's a 1, 2, 3. I'm going to take my signal. No, doesn't work that way. That's a lot better, don't you think? Because it didn't just hold up once, twice. Here, it just ran the other side. That's normal. It happens. That's why your stop goes on the far edge. Do you have plenty of room to make profit? You already took your profit. You already got out. You took the trade here because you're smart and because you watched this strategy session and you thought, man, this guy's really on to something. Now, don't mishear me. I'm not on something. I'm on to something. There you go. So there's your trade, and you trade back up into these highs, and you got 1.4. It's a beautiful trade. I love it. Very nice. Your stop, you had plenty of room. You already hit target here. Do you need to trade it again? No. Why? You already took the trade. Wait for the next one. There's plenty of trades. Let's go to MNQ. Anybody here trade MNQ? Of course you do. Everybody trades MNQ. Any amazing trading view indicator to gold scalping? I tell you what, we'll look at gold scalping for you, Chris. Got you covered. You got it. I'll show you some stuff. After a retest of the balance zone, would you consider entering after a retest of a fair value gap? No, I hate fair value gaps, but hate them. Why? Because of that. What happened on this fair value gap? It came right back through and colored in the whole darn thing. Why? Because there's balance zone. So fair value gap after balance zone, no, not interested. Where's your balance zone? It is really, this is where it starts. And then it just kind of fakes out both sides. So what do? You can expand it to include those. And that becomes your balance zone. Okay. Fake out, psych. Trader one just almost got stopped out. And then they felt like a champion because there was this huge run up. This is your imbalance outside of balance. Trader two got in on the retest right here. They're feeling great because they traded all the way back to the highs. Little do they know, they have a strategy that has very little profit factor available. The smart trader says this is the high that left this balance zone. I don't trade nothing until I break outside of that, because anything inside of here is noise. So you don't want to trade it. So what do? You find the level that retested after it left, and then you plot the order block around that. So the order block is actually this. I'm not going to go into advanced order block plotting in this session. It's a huge ball of wax. But we're going to do that. That's our order block. Just trust me. I don't have time to go through the whole thing. And what happened here? We had a little bit of a reaction and then ultimately got run over. Okay. So it does happen. There's no such thing as a sure thing. The problem with this is by time we came out of here, we have numerous other balance zones to pay attention to. And the market came out of this balance zone, broke, retested, broke again. This is where we want to trade now, not this. So you always want to trade based on the context of what is actually happening in real time. There you go. Order block is going to be all of this. And there's the retest right there. Retested numerous times on the other side. So this one didn't hold because the market had already shifted. When we came out of this zone, we had this huge level. Then we kept pushing. Well, what happened outside of this push? Who's in control of the market at this point? Who can tell me? Buyers or sellers? Who's in control? Anybody got an idea? Yeah, sellers. Exactly. The whole reason we waited to get in on the balance, break, retest, break is because we wanted the buyers to be in control. If the buyers are no longer in control, why would we want to trade against the sellers? Could we get a nice trade? Yeah, we could, but it's just always better to trade with the control of the market. So if we look at this market, we can identify what's the story. Buyers got in, ran some stops, took some profit. That pushed the market down. Buyers re-entered, pushed, stop run, came down, stop run, came up, tagged the highs, came down, tagged the highs again with another stop run, slam. This is your sign that the market just shifted. How do we know that? It usually looks like this. Not always, but usually looks like this. Nice impulse. Impulse is a wave going in your direction that breaks structure. Okay. Impulse, correction, sweep. This is not an impulse. Never closed above the highs. That's a sweep. Sweep again. Uh-oh. Now we don't know what's going to happen. What we do know is that this trend is running out of steam and is subject to a regime change. Sweep again, came up, lower high retest, push down. There's no direction yet. Push back up, another sweep, followed by a break. And there's your clean break of your move. You also want to see a break of the last impulse, which is this right here. There's your break. That's your sign that the regime has changed to selling. You can see it as absorption, absorption, absorption. This is exhaustion because it's a lower high. Push, exhaustion, absorption again, break. There's your reaction. That's your sign that it's time to go the other way. Distribution, yeah. Exactly. So that's how you can determine who's in control of the market. It looks like, look at your highs. Did it make a new high? Not really. Did it make a new high? A little bit. Did it make a new high? No. If you measure the distance between these highs, look at what happens. This is a nice big move up, a little tiny move. What happened here to here? Little tiny move. That's your sign. When you see that the difference between this high and that high is good, but then this one starts to get smaller and smaller, and then it taps out, and then it breaks the low, the market has shifted. That's how you can tell who's in control. So this is why we wait. Now, if you're a reversal trader, this is gold to you. This is what you look for. You're watching for the train to start pumping the brakes. You're watching for those liquidity sweeps. And when you see the push down, that's when you're looking to reverse. Trend traders, you're looking for the break, pullback, break. Restraint, wait for your opportunity. There's a couple ways you could trade this. You could trade anchored VWAPs, you could trade order blocks, you could trade a bunch of stuff. There's another opportunity there. This one got run over. That was your imbalance moving back down. Okay. Yeah, have a great weekend. Appreciate it. So there's the idea. Let's go a little further back. Let's see if we can find some more balance and imbalance. And I'm going to give you some homework. Let's go back to our presentation for a second because I do have this plotted out. So we just went through all of this. Limit orders provide liquidity. Market orders consume the liquidity. Stop orders become aggressive because they are market orders. Buyers lift the ask when they go to the ask and above. Price goes up. Yeah, you definitely don't want to guess if you're getting a reversal. You want to see it in action. Yeah, I'll show you. I'll show you again. Sellers hit the bid, right? They're looking for, and then the imbalance forces price to start looking for new balance. The imbalance is that distribution or whatever. You can look at accumulation distribution. There's different terms for it. I just look at it as balance versus imbalance. Like balance looks like this. Imbalance looks like that. Okay. Chop chop or one-sided. There you go. We know that aggression moves price. One side overwhelms the other. Aggression moves the price. Absorption prevents directional progress. It looks like that. You've got lower, if we'll just do that. There we go. This move is stronger than that move. This impulse is slower than this impulse. This one's bigger. Watch those impulses and determine, you can see the market slowing. Big move. Littler move. Littler move. Littler move. Tapped out. Good stuff. These should all end up, I suppose, on YouTube or on the Tickblaze site or something. Yeah, we'll definitely get them to you. You're welcome to review them anytime. So that's absorption. Exhaustion is when participation fades. So you have absorption here, absorption, exhaustion is here. When it runs out of new room, that's exhaustion. And then the stops can accelerate the market movement. So where are your stops? If you're a buyer, your stops are here, here, and here. So as you start punching through these levels, what happens is you have tons of sellers in the form of stop orders, which are going to the bid, which is moving the price. And then you have the FOMO traders that we just talked about that trade the breakout without any confirmation. The continuation suggests that liquidity was consumed. Reaction reveals which side has control. That's your reaction. All about balance versus imbalance. That's what it looks like. We'll look at another rotation too. So identifying the balance. Let's put this into rules, because everything we do has to be rules-based, right? Rules-based. Overlapping variable range candles, not range candles, not Renko candles. Overlapping variable range. That's time, that's volume, that's tick. Those are variable range bars. Alternating bullish and bearish candles, at least 4 candles in rotation. What does that look like? Up, down, up, down. There's your balance. 1, 2, 3, 4. Up, down, up, down. That's your balance. That's how you can find it very easily. So we're putting it into rules now. Limited directional progress. You could have up, down, up, down. Is that a balance? No, because you're making new ground. Technically, it's an up, down, but you want them to be overlapping like that, or like that, down, up, okay? Not up, down, no. Mark the high and the low. Treat the zone as a temporary market agreement. You don't know what's going to happen yet. The first break proves nothing. This is where traders get trapped. This is the FOMO trader. Ooh, it's going. I got to jump in. No, you don't. You need to wait and see if price is going to confirm that move. The first break is just testing liquidity. Price often, I can't say always, often returns to prior balance. That is the desire of the market. The market may rotate and may reverse direction. You see it, chop, 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 psych, go. We don't know yet. Structure break does not guarantee a new trend. You could go down, up, down. Doesn't always guarantee a new trend. The first move is just the information. The momentum needs to be confirmed. The momentum looks like it left the zone, it stayed out of the zone. That's how you confirm the imbalance. Identify the balance zone, wait for a full candle outside. Open, high, low, close. That's what we looked at. Wait for price to return. Balance, one open, high, low, close above, returned to the zone. Mark the excursion level. The excursion is what is the highest high outside after it created an open, high, low, close. Okay. Require the close beyond this excursion. So once it retests, you want to see the close outside. Then you plot the order block that caused the break. The order block is going to be at this low that broke through. Then you trade the retracement into the order block. Extra rules. Take a screenshot of this if you like. These are the rules. I'll give you a second to take a screenshot of this. And then we're going to look at the chart some more. We're going to spend a little extra time. You know, I never know how long these things are going to take. So we'll get a little extra time in. And if you have to run, no worries. We'll get you the recording. Okay, good. You guys got your screenshots? Got what you need? We're going to go look at it on the chart too. And we'll label it out. Okay. Trade the context, not the breakout. So apply the process through the trade review and live market planning. So how do you plan out anything? You go backwards first. Look at historical charts. Look at how that's supposed to work. Then you trade it forward in sim. Trade it in sim first. Review a successful confirmed break. Review a failed break. Build a bullish and bearish live scenario. Define the entry, invalidation, target. Yeah, you're welcome. You're welcome, Ken. I'm glad. Find 3 historical examples. I would do a lot more, but that's me. And then grade the execution by the process, not the outcome. Did you follow the plan, not the outcome? So let's go to the charts again, and let's just go into it. Let's go to GC. I had somebody that asked for, how do I scalp with GC? There's a couple ways you can do it. If you're newer to trading, I would recommend starting, I'm going to go way back. I'm just going to go to a random day. Here we go. Start on a 5-minute if you're new to trading. If you're more advanced, you can size down, go into a volume or tick-based chart. But start with a 5-minute. That's the easiest. Very good probability. So we're looking for down, up, down, up. We have one here. It's kind of hard to see. But if we zoom in, we can see that there's a little doji candle right here. Technically, I don't like the wick, right? Like this gained new ground. So to me, that's, you want it to be overlapping, and that's not overlapping. These 3 are, but that one's not. So you want them to be overlapping inside a range. Down, up, down. That's it. You want 4 in a row. So we keep going. Down, up, down, up. You guys see it? Right there. Did it gain new ground? A little bit. Not your job yet to figure out what filters to use for those zones. Your job is to plot all of them at first and then see what happens, you know? So there's your zone. Did it ever come back to retest? No. Well, then it's probably not a very good balance zone because it never came back. There's too much movement. You want them overlapping. Up, down, but it's moving. It's moving higher. No deal. Down, up, but it already broke. No deal. Up, down, up, down. No. Some of you are thinking back to the old days of the up, down, left, right, BA, start. Some of you have no idea what I'm talking about, and that's fine. There might be one of you that knew that reference. Let's see. Right here. There it is. Up, down, up, down. Clearly it's going sideways. There's your balance zone. Highlight the candles. There we go. The bunny hop. No. Came out. One open, high, low, close above. Great. Mark your excursion. It's right there. What happened? It went through the other side. No deal. Sorry. We don't have anything yet. So we keep going. I'm going to kind of fly through this a little bit faster now that we know what we're looking for. Down, up, down, up. That looks like a balance zone. They're overlapping. There we go. There's your balance zone. Psych, 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 go. Did it ever come back to test? Well, you can expand it. There's your retest. You can expand it down here. There's your zone. So we have down, up, sweep, came down, sweep, down. What it's doing is that it's expanding, right? You have kind of this type of thing going on where you've got that, and it becomes kind of like the megaphone type of look, where it kind of expanded there. But really all it's doing is it's sweeping this level. and then it broke, came back, retested. So this one's a little bit more complicated. Would be totally okay if you skipped this one, but there's your excursion, came back, tested, and then off to the races. So where's your order block in here? It's right here. It's this candle. That's the one that created the low. We do that. We can say settings, extend. Okay. There's your zone. When it comes back into this zone, who's in control? Does it work? Yeah. Works exceptionally well. But your buyers are not in control here. There's technically nobody in control at this point, but it's not one you'd look to trade. Could it work? Sure, it could. But you're better off just trading with control of the market. That's the whole point of this. Here's one, but it never left, so we'll just skip it. Down, up, down, up. It's pretty wide. It's getting lower lows. Up, down, up, down. Here we go. There's one right there. So you'd go from here. It's a pretty big wick. I'm not crazy about it, but it looks like that. And then if you have one candle that's kind of right there, you could extend it or not. It don't matter. There's your open high-low close outside of the zone. Mark the excursion. What happened with this balance zone? Man, it returned so many times. It's kind of ridiculous. Is there still opportunity here? This is the zone that, caused, or the price action that caused it to move down. What you have here is this massive sprawling balance zone. And in this case, it gets run over. So if you see it doing this, where it fails to leave, just wait for the next one. You want clean. You want it to set up according to your rules. That's not really clean. So you got this. Let's do one here. This one expanded a little bit. You have down, up, down, down. It's not great, but we'll run with it to demonstrate. There we go. So this is kind of, we're going to skip it. Even though it works, I'm going to skip it because I want to use really clean examples for this, where you have a very clear balance zone. This one closed above the high, so no. We'll skip the gaps. It's not what we're looking at here. Gold doesn't give us a whole lot on the 5-minute. Let's see. There's one. There's your down, up, down, up, down. Did it move anywhere? No. It got really, really stuck. And then it swept both sides. Never got the open high-low close outside of it yet. Never came back to retest. No deal. Let's try up, down, up, down, up, down, up, down, up, down. It's kind of moving down. We'll skip it. Here. Clearly overlapping right here. Did it leave? Yes, but then it kept going. Kept going through the other side. No deal. Let's go to a different market. We'll look here. Here's one. Up, down, down, up, down, up, down, up, down, up. Yeah, this one definitely, right? There to there. And then as it kind of sweeps through, you can expand these. If it sweeps and goes out, you've got your open, high, low, close beyond right here. There we go. There's your break. So what are you looking for? Now that you've broken, now that I finally found one, now that you've broken through, you're looking for what is the order block that led to the break. So what we're going to do, where's your close beyond? It's right here. Okay, there's your close beyond the zone, beyond the excursion, I should say. When it closes beyond the excursion, you're looking at what is the pivot high that led to the break. And it's right here. You guys see that? Because your pivots look like this. Dun, dun, dun. Okay. The order block then is going to be at least the last bullish candle right here. At least. Now, I'm not going to go into advanced order block concepts, but that's the order block. If you want to make it easy, just do the last bullish bar at the high. Okay. So this was our original zone. There's our new one. There's the retest. What's the reaction? Pretty damn strong. Are the sellers in control at this point? What do you guys think? Let's do this. And I'm going to move it over. So this is our analysis. Who's in control of the market right here? What do you guys think? How do we determine who's in control? Where is your impulse? An impulse is a wave that breaks structure. There's your impulse. We are still inside of that impulse. Therefore, sellers never lost control. Technically, there's really no control in here, right? It's going sideways. But what happens is it sweeps this level, grabs the liquidity that's hanging in this area, and slams down. It's a beautiful trade. Very, very nice. So there's the trade. So let's mark out, where do we start? There's our up, or sorry, there's our down. Let's do this. Whoops. Let's use black so we can see what the heck we're doing. Okay. So we have down, up, down, up, down, up. This is what technically would start the zone. So let's fix it. Let's make it a little clearer, because these are included into here. There we go. Still open, high, low, close beyond, but barely. Barely, but it works. So you can expand it if you want to. You don't have to. It's really up to you. I like to just kind of leave it at the original so I can see the fake outs on both sides, right? So there's our up, down, up, down. That's our condition one to create the zone. And it really stops here once you have an extra bullish. Okay, now we're looking for open, high, low, close beyond the zone. That's number 2. Then we're plotting the excursion level. The close beyond the excursion is 3. Once we do that, we plot our order block. That's number 4. Then we trade the retest, which is number 5. And number 6 is we take the money to the bank. Take a screenshot. Let me know when you've got your screenshot. Got it? Good. So when you're trading, again on Monday, I assume you're probably done trading for the day. When you're back to trading on Monday again, plot out the balance zones. If nothing else, even if you don't trade this, it's good to know where they are. I call them landmines because the market always comes back, and when you try to trade them, you usually get blown up unless you know what you're doing. Market regime is everything on trading. Everything. Market regime will either make you money, and if you don't understand it, you're going to have a really tough time. It's not to say that you can't make money, but it's going to be really tough. So there you go. Balance versus imbalance. Let's go to MNQ again. So there's a good way to trade gold on a really good actionable trading plan that you can You could do very well with that. We could look at another zone here while we're at it. We've got up, down, but it's moving up. So nothing there. Let's get out of there. Notice what happens here. After, when it finally came through and ran through the other side, what happens? It creates balance in the same area again. Up, down, up, down. Remember, the market likes these levels because that's where it's in balance. There's your level. There's your break. Close right here. Your zone would be this guy right here. Yeah, it'd be right there. That one would be a stop out. It's an honest stop out. Sellers were in control, but then they took out this level. I would have traded this for sure. Can't win them all, but very strong. Let's go to MNQ, and then we'll wrap up and call it a day. All right, so let's go to the hard right edge. What do you guys see on the hard right edge? First of all, let's get a context for the market. Huge down move, sweep, faked you out. Sellers came back, swept, came all the way back up and swept again. So what's happening in the market right now is it's finding new territory. It's deciding where we're going to trade. Are we going to be bullish? We don't know yet, but we broke through the impulse. Yeah. We got a pullback. Yeah. And now we're topping out at the highs. Anytime you see this, where you've got clean break, and it is clean, sweep, break, you're looking at a double sweep off of the market open, which happens a lot in NQ. You got a double sweep. We don't know what's going to happen until we break outside of one of these. Until we do that, we're stuck inside. Okay. Now this is a 5 minute, so it's a little bit slower, but here's your zone right here. So we're seeing it in real time. Hard right edge. There's our balance zone. Do we have an open high low close above? Yeah. What are we waiting for next? A retest. Then the break, then the pullback, then we can finally trade. Let's go back and see if there's any others in the pre-market. This one, yes, but it plowed through the other side. No, yeah, there's one here. Came out, plowed through the other side. Here's one. Up, down, up, down. There you go. Stayed out, came back and retested. Mark the low before the retest. When you get the close down here, plot the order block. It's right here. And wait for the pullback into this level. Never came back. Is it still valid? Not if the buyers are in control. I wouldn't trade it. Let's look at this one. Down, up, down. But it's still, these candles are all still inside these. So I'll let you decide, when you want to start building this out more. But for now, just do up, down, or vice versa. This one ran through both sides anyway, so wouldn't be something that we'd be looking at. Up, down, mostly inside, right? So we can go here to here. That's your range. Came out, tagged. There's your low, closed below right here. Go back to the high, plot your order block. The order block is actually this whole thing. There's your trade. All the way down. Good stuff. What do you guys think? We took a little bit more time to really drive it home. This is one of the most important concepts in trading. You've got some knowledge. You've got some actionable trading plotting, plotting your charts. and you have an actionable plan on how you can trade it. And here's the beauty. You didn't need any indicators to do this. No indicators whatsoever. Amazing. So you don't have to buy anything. Isn't that great? Free knowledge. Let me tell you, look, I've never seen anybody teach this before. Uh, I don't know if it exists, but you learned it here. So tell your friends, send them the replay. Let's keep growing this to becoming bigger and bigger, because if it continues to grow, we will continue to do it. Okay. So the first version of Tradecraft is in the books. We did it. We did it. So hopefully you guys enjoyed that. I enjoyed teaching it. I really enjoy geeking out on this stuff. I realize for some of you, this might be more advanced, but advanced without being complicated is what will make you money. Is it complicated? No, it's just you need to understand the rules. So yeah, he's doing okay. Yeah, but all good, Philip. Thanks. Yeah, he's okay. Yeah, evaluate the market. Who's in control? What's the regime? That's what you're looking at. Yeah, you're welcome. I'm glad to step back into the classroom. I don't get to do this stuff too often, and that's why we wanted to do this. This is just my way of giving back. It doesn't cost you anything. It's my way of passing along some knowledge and some insight and some trading, and life is good. So cool. All right, I'm going to leave it here for another couple minutes so you can take some images if you like, do your thing. But otherwise, thanks for tuning in. We will see you on the next one. We'll be back at it again next week. And come in and join us. If you're traveling, enjoy your vacations and breaks and time on the beach or whatever you decide to do this summer. But we'll see you back next week. So thanks, guys. Cheers, and keep trading well. Let me know how it goes, too. Keep me posted.